If you're a business owner, these are 3 underused tax deductions that you need to know about. Before we get started though, this is not tax advice, so make sure to go over these deductions with your tax professional. In simple terms, tax deductions are like the discounts on the money you have to pay in taxes. When you have certain expenses that are deductible, those can be subtracted from the total amount of money that you made that year. Deductions lower your taxable income based on your highest federal income tax bracket. So if you fall into the 22% tax bracket, a $1,000 tax deduction would save you $220. What a tax deduction is not is a tax credit. The difference between them is a tax deduction lowers your taxable income, while a tax credit directly reduces your tax bill. For example, a tax credit of $1,000 would lower your taxes by $1,000. The first deduction is called the gift leaseback technique and allows you to deduct your assets twice. Let's say I have a car, a computer, or any other equipment you've used for your business, though this can be used for non-business assets also. Once I've depreciated that asset down to 0, meaning I've already taken all the deductions I can get from it, I can gift that to someone else in a lower tax bracket and lease it back from them. Now, why would you want to do that? Let's say you have a kid in college that needs some financial assistance. Rather than just giving them money, you gift them the asset, rent it back, they get the income on it, and you get to keep using the asset. For example, you gift them your car and lease it back. You get the write-off for the lease expense, reducing the amount of taxes you pay, and they get the income. Now they'll probably have to pay some taxes on that income, but they're in a much lower tax bracket than you are, so the net money to the government is minimized, and you keep that money working for your family more efficiently. This is a very high-level strategy, and there are other rules that you need to be aware of. So again, speak with your tax professional before using this. The second deduction is for anyone who runs their business from their home. CPAs will usually divide the square footage of your home office by the square footage of your home to find business use. So if we assume your home office is a 100 square foot bedroom in a 2,000 square foot house, you would have 5% business use. This means you'd be able to deduct 5% of your mortgage interest, alarm services, utilities, lawn care, and a whole bunch of other stuff. What most at-home business owners don't know is a little loophole I like to call the blueprint magic trick. So first, you want to find the blueprints and familiarize yourself with the dimensions, and then eliminate any common areas in your house like hallways or throughways. Let's just say you could eliminate 400 square feet of hallways. Now you have 100 feet divided by 1,600 square feet instead of 2,000, which is 6.25% deduction instead of 5%. You just increased your deductions by 25% without lifting a finger. The third tax deduction is one you may be familiar with, but I'm going to show you how it can be used for your business to put large amounts of tax-free money from your business into your pocket. It's called the Augusta Rule, and it allows you to rent your house up to 14 times per year without needing to report rental income on your tax returns. This rule applies to any taxpayer who owns a home in the United States and includes primary and secondary residents and even vacation homes. Now, where this becomes really powerful is for business owners. For example, you host a monthly meeting with your board of directors. Under the Augusta Rule, your business can pay you a reasonable amount to rent your house to conduct your monthly meetings. You are then able to deduct the rent payment from your business tax return, and you won't have to report it as income on your personal taxes. But before you go trying to rent your house for $100,000, you must first understand the rules behind this strategy. First, and potentially the most important, if you are renting your own home through your business, it's critical that you have a detailed documentation of your work. This could include printing rental quotes for similar locations, keeping track of minutes worked, and other records of business discussions. Second, your house cannot be your primary place for business. Third, this business deduction is not available for sole proprietorships or single member LLCs. In other words, if you want to use this as a business deduction, you need to file as an S Corp or C Corp. And finally, the rent you pay cannot be unreasonable, meaning you can't charge your business $10,000 a night if other homes similar to yours are only going for $1,000 a night. In summary, the Augusta Rule is a really great strategy to take money that is taxable in one pocket and move it over to a tax-free pocket. And finally, for a bonus, if you want to learn how to sell your home to your S Corp and exclude up to $250,000 to $500,000 from your home sale profits, then click the link below and grab a free copy of the Codebreaker, which will walk you through this strategy and 7 other underused tax deductions. If you found value from this video, consider subscribing or sharing with other people that could value from this information. We'll see you on the next video.